Welcome to the deal analysis section of myapp.property. Let's jump in. The advanced calculator is much more advanced than the basic calculator and gives you a much more comprehensive view of whether the deal does make financial sense or not. And as part of this tutorial, I'm going to take you through a live block of flats to show you how you would go through the process of analyzing this deal. Now, please, the numbers that I'm going to show you now are not necessarily vetted or validated. I'm going to be using the advertisement link on Property 24 given by the agent. So none of the due diligence has been done. Please don't go and buy this property now off the back of this tutorial thinking that it's a great deal. Merely what I'm trying to show you is the process, what steps you must take and how you must think. Always remember that once you have your offer and you sign the offer to purchase, you're going to make it subject to a 2-week due diligence period. And during those 2 weeks, you're going to prove everything, prove income and expense. So this is the deal that I have as a case study. This is a deal that I have looked at extensively in the past, and I have actually done a lot of due diligence on this block. And I have some potential interest on it. I'm busy with a couple of other buildings. So this one is kind of on the back burner, but just to, again, give you context of what the process flow should be, this is what the block looks like. So we just want to look at some of the information so that we can allocate it onto our app. So the asking price is 1.45. It's 9 units. It's making 27,700 in rental, and the rates and taxes is 1.5. So I'm going to go to my app. I'm going to analyze a new deal. I'll put the block's name here, Morwell Court. And remember to take your URL, paste it here so that in future, when you're looking at the deal again and you want to see the advertisement that kind of got you interested, you know where to look. Acquisition costs. So the asking price was 1.45. The purchase price will be 1,050. Market value is probably about 1.5 million. Now your bond and transfer costs, you can just use the calculator here on transfer fees, but I'm just going to say that it's 65,000 for the 3. And then renovation costs, we projected about 180,000. There was quite a lot of work to be done. I'm not planning to sell, so I'm not going to put my selling costs there. Then we go to finance. So I'm going to add a new finance tab here. Now, finance with these kind of buildings is a bit tricky. You're going to go for commercial finance, which means you're either going to get prime plus 1 over 10 years, or you're going to go the DCSR model. That's using a company like Tough to be able to finance based on the income. This is the one that I prefer. So let's work on a 700,000 Rand loan, and that's going to be my monthly bond repayment. Now we go to the cash flow tab. The monthly rental is 27,700. The occupancy rate will be about 95%. Additional income and recoveries, you can put it in. I tend to leave it out because and then I also leave out my expense items here. So instead of putting water, electricity, sewage as an expense line and then having a recovery line, you can kind of mitigate the two, but let's just add them for interest sake. So let's say that you can get another 1,200 per month for parking, and your recoveries will be about 2,500. Management fee, my managing agent charges 8%. Maintenance, I'll make 8%. Levies are 0. Blocks of flats don't have levies. 1,500 for rates and taxes. Insurance will be 650. Water, electricity, refuge will be 2,500. As you can see here, this amount and this amount should equal, because these are consumptive-based costs that we can pass on to our tenant. And then security and cleaning will be that, and electricity, let's make 1,500. Save. Now we go to other inputs. This is very important with this calculator because we're looking at projecting the returns over the next 20 years. So we need to know some of these kind of escalations. So we're going to work on 27% income tax and 18% capital gains. And then we're going to work on capital growth of 7%, capital growth of 3%. That's the appreciation of the value of the property. Rental growth of 7%, inflation of 5.5%, sustainable growth rate of 5%, and discount rate of 10%. If you don't know what I'm talking about here, get some coaching or work with someone who's got experience in that market. If you're in the lower income space, doing the same kind of deals that I'm doing, you can use these as an example or as a template. But, make sure that you're getting some sort of, coaching or advice from someone who's experienced. And then sensitivity levels, we want to understand how far this deal can go before it becomes a bad deal. So we're going to look at a bear, base, and bull case scenario. Bull being optimistic, base being neutral, and bear being pessimistic.
And now we go to the final tab, the summary tab, and this is where it's telling you whether it's a good deal or not. There's quite a lot of data and reporting on this page, so it can be a bit overwhelming. Don't worry, as you do this more often, you'll get more used to it. The first tab is the overview tab. This is telling you at a high level what the numbers look like. So your discount to market value, your asking price, offer price, and market value. So it's a very, very high level overview of essentially what your purchase price is. Then the next tab is called scenarios. This is where we look at the bear, base, and bull case. Bear being pessimistic, base being neutral, and bull being optimistic. So first you can see gross rent excluding recoveries. So your base case will be your neutral stance, and then the bear and bull would be based on those sensitivity levels. It's either 10% higher or 10% lower. Then you have your recoveries. Then we have gross yield based on this income generated. So for our base case, it's the 305,000 divided by our purchase price, which gives you this yield. And then you've got your gross yield for your bear and your bull. Then you have your expenses. Again, it's using the sensitivity labels, but here you can see what your gross expenses are, your annual interest expense. So if you've got finance on the deal, you're able to deduct that before you taxed. So that's why we use it as a separate line item. And then your cash flow post-tax, so after income tax has been paid, based again on the other inputs. In this case, I use 27% because I'm buying through a company. If you're buying in your personal name, you'll obviously have to adjust that. But this is what your cash flow would look like on your base case, your bear, and your bull. Then the next tab is called returns. This is where we start to see some of the dials of whether this is a good deal or not. The most important one, in my opinion, is the first one, IRR, internal rate of return. That is telling you the rate of the return that you could expect from this deal over the longevity of holding this deal. So in this case, it's 33.76%, which is phenomenal. Your NPV, your net present value, is the growth in your wealth or your equity based on the purchase in today's terms. So 3.5. These two indicators, the IRR and the NPV, are what I use mostly when deciding whether I want to proceed with the deal or not. Then we have net yield. This is kind of like your cash on cash returns day one. Your cap rate, which is used more when looking at comparing different deals in the same area and specifically in your commercial space. Your debt service coverage ratio model, which basically says how much of your rental income is servicing your debt. And you want to try and keep this number under 1.5. Then your operating expense ratio, what's the percentage of your income that goes towards your operating expense, and how long will it take to pay back your initial capital invested, in this case, 5 years. And again, lots of dials, and you've got your bear, your base, and your bull case, so you can see, how far you can push your deal. The next tab is the equity and debt ratio. So this is showing you three things. It's showing you your equity, which is in the blue, your market value, which is in green, and your outstanding bond. Remember, we've got a 15-year term, so you can see that the bond starts at 686, and then slowly over time, by the time we hit year 15, that has been paid off. Your market value is appreciating based on the escalation percentage you put in the previous tab. So it's showing you the growth, and then the equity is the difference between your market value and your outstanding bond. Then we have operating profit. This is showing you over the next 20 years what your income is, which is in blue, your expense, which is in green, and then your gross profit. So this is excluding your finance costs and excluding your tax. If you want to see those numbers, you go to your net profit. And that's what this is showing you. It's showing you your gross profit, which is the blue, your finance costs, your tax in yellow, and then your net profit. That is your post-finance, post-tax profit at the end of each year. And then if you hover over each one, you can start to see what the numbers are specifically for that year. Next, we have the CapEx spend. This is showing you where your costs are being allocated. So 450,000 of your own money, your CapEx spend is going towards your deposit, which means 72% of your money would be for the deposit. Then you've got your renovation and inspection costs and your transfer costs. So it's a nice graph for you to see where your capital spend is going. And then your final tab is showing your project cash flow, your cash flow per year, cumulative cash flow, and yearly ROI.
I hope this tutorial answered your questions. If not, please contact us via the chat and email functionality in the menu bar. If you are looking for more support, maybe some one-on-one coaching, upgrade your membership to the Platinum package, and you'll have some one-on-one time with me.